Right. The topic that we are going to cover today is currency derivatives. So that include the forward contract, you know what, the currency futures and currency options. Let me share this one. Okay. All right. Good. So currency derivatives that include the forward contract, futures contract, and options contract are usually used uh, for hedging purpose, hedging against the exchange rate risk, and then the speculative investment purpose. So both ways, like risk management and investment performance. So we'll talk about all about this today. So let's start with the currency forward contract. Is the as we covered this one in chapter 3 briefly, and then this is the contract between multinational corporation and the bank that company's bank to exchange for exchange rate risk hedging. So they exchange a specified amount of currency and at the specified rate and on a specific date in the future. So this is contract for the exchange of foreign currency in the future at the specified pre-specified rate, which is called forward rate. So that's what we do. The main feature of this one is that the multinational corporation, they don't like the exchange rate risk. Okay, so they have to find some way to eliminate this exchange rate risk. The typical way is to go for forward contract, like foreign currency forward contract. Okay. Now for this one, this is one example here. This is the British pound. If the spot rate, the current spot rate is 1.681, and these are like example, like forward rate for like 30-day forward rate and 90-day forward rate and 180-day forward rate. So if you look at this one, this forward rate are lower than the spot rate, right? In that case, we say this one is a forward discount. So the British pound is at forward discount. Now, I think you remember this one here. But now, given this like spot rate and forward rate and the maturity, 30, 90 days and 180 days, then you can calculate the size or the magnitude of forward discount or forward premium. In this case, the forward rate are all below this spot rate. So this one is obviously discount rate. So here, discount. So if you calculate this one, the forward rate minus spot rate divided by spot rate, that is the formula for the for discount or premium. But you have to adjust for this annualized portion. So this is for only 30-year forward rate. You have to divide that by 30 360 1 year divided by 30 days. So if it is minus 0.71 means minus sign, that means this is this for discount, all right? So, and this is the size of it. So, British pound 30-year forward rate, right? British pound is at the discount, is for discount by 0.71%. So in this case, 180 days forward rate, the British pound is at for discount by 1.07%. That's how you do that. Discount describe. All right, that was forward contract. And currency futures contract. Let's talk about that. All right. Aiden.
Well,
Wait a second.
can you hear me?
I can't hear you. Wait a second. On up volume. Yeah. Aiden.
Can you hear me?
Yeah. No. Okay. Now can you read the first four?
The first four of the top, like 19,
Yeah,
20,
this one.
21, 22. Standardized, which is for quality, quantity, expiration date, traded at exchange rates, CME, not OTC. Less liquidity risk, default risk, credit risk, can easily offset the obligation, mostly very few by delivery, and initial margin requirement is 3 to 6% of the value of the contract.
All right, thank you. This we talk about Ford contract, right? Ford contract. Now, Ford futures. I'm futures contract. Now, currency futures is similar to the Ford contract in terms of obligation to purchase or sell currency on a specified, the settlement date in the future at the specified rate. But this one is this one is quite different. So first, these futures contracts are usually standardized in terms of quality, in terms of quantity, and expiration date. And because of this standardized, like the feature, these futures contracts are traded at exchange market, right? Primarily the Chicago Mercantile Exchange or Philadelphia. All right. So it is not on over-the-counter market, right? Over-the-counter market. And then because of this feature and then this standardization and trading at the formal exchange market, there's less liquidity risk, default risk, or credit risk. Risk is overall is lower and can easily offset the obligation mostly. So that's the most like approach. But sometimes very few, very few by actual delivery. Okay, I'll explain what that means later. And there is an initial margin requirement there, usually 3 to 6% of the value of the contract. So if you are doing this futures contract, trading a futures contract, you have to carry the initial margin, the amount in your account, margin account. And Konstantin,
Yep.
yeah, finish that, please.
Where are we exactly?
Maintenance.
Maintenance margin requirement, daily settlement, making to market, like a series of daily forward contract, bankers, brokers, multinational, qualified speculators, regulated by Commodities Futures Commission, National Futures Association.
All right, thank you. So your initial like margin requirement, that is one requirement. And also there is a maintenance margin requirement. So for the traders or the investors, you need this one here, you need this. I'll show you what that means later on. And then daily settlement is the important feature of futures contract. Is called marking to market, and it's like a series of daily forward contract. So, I'll show you that in below. There below, in the example. And then the major participants include the bankers, brokers, and multinational corporations and qualified speculators, investors. Okay. And then regulated by Commodities Futures Commission and National Futures Association. because they are like traded in exchange market. You have to follow that. And this one is like more detailed description of it, of this one, but that is included, mostly included in here. All right, let's talk about some actual trading example, trading currency futures. Devin?
Yeah.
Yeah, please go over this.
All right. Trading currency futures. Firms or individuals can execute orders for currency futures contracts by calling brokerage firms. Electronic trading platforms also serve as a broker. Third Wednesday of March, June, September, December are the settlement date. A long futures position is a futures trading strategy where a trader buys a futures contract expecting the underlying asset's price will rise. And a short futures position is a trading strategy where a trader sells a futures contract to profit from a drop in the asset's price.
All right, thank you. So firms or individuals, investors, right, speculators, they can execute orders for currency futures contract by calling brokerage firms. So you call brokerage companies and then ask for the trading, right? You broker and they will do the execution of your order. And also there's electronic trading platforms also used as a broker, serve as a broker. And settlement date usually include the third Wednesday of March, June, September, December. That's a standardized, right? I told you standardized in terms of like quality, quantity, expiration date, right? So quantity will be like explained this one, here quantity is standardized quantity. Some example. All right, long position, long futures position is the futures trading strategy where a trader buys a futures contract expecting the underlying assets price will rise there. So long futures, if you see the word long, that means you are in buy position, right? Buy position. So you buy futures contract. That's your long position. Why do you buy futures contract? It happens. I mean, you do this one. It's a strategy, right? You do this one when you believe that the currency value, exchange rate will will increase, will appreciate in the future, right? So if you believe the a currency's like value will appreciate in the future, then you want to like uh, lock in the reasonable like exchange rate by longing futures position. So if this one the currency value increases this way, then you will enjoy some profit there. Okay. So short futures position is the trading strategy where a trader sell futures contract. So if you see the word short, means you are in sell position. Okay, sell position. Why do you need that? If you think the future exchange rate, the currency value will depreciate, then you take on this short position and then enjoy this like you know uh, the profit there. Okay, so it is kind of uh, long position, short position, they are used to either like eliminate exchange rate risk or speculative investment. I mean, a speculative investment is like your goal is to get the profit based on your projection, based on your expectation, and take your position, either long position or short position, and then get the profit. That's the speculative investment. All right. All right. Some example. I mean, why do company use currency futures? What is the main goal? We have this one here now. Dushan? Dushan? Destiny?
Yeah.
Yeah, can you finish this one, please?
The one that says firms use currency futures, right?
Yeah, this one, yeah.
Okay. Purchasing futures to hedge payables by locking in the price at which a firm can purchase a currency. Selling futures to hedge receivables by locking in the price at which a firm can sell a currency. Closing out a futures position. Sellers or buyers of currency futures can close out their positions by buying or selling identical futures contracts prior to settlement.
All right, thank you. So purchasing futures to hedge payables. Now you buy futures contract to hedge payables. So that means if you have the payment obligation in the future, right? Multinational corporation. If you have the payment obligation, like you have to deliver like 1 million British pound to British company in 1 month. If you have that payable, then as you said, as you see, between now and 1 month, we have no idea what's going to happen to the British pound, right? So that is exactly exchange rate risk. So you want to like eliminate this exchange rate risk by purchasing futures contract. So by purchasing futures contract on British pound, 1 million British pound, and lock in the price at which the company can purchase a currency in the future, right? So because of this uncertainty or exchange rate risk, you want to get into purchase like this futures contract for British pound to lock in the price at which we can purchase a currency. All right, selling futures currencies. Selling futures currencies, futures like the contract is to hedge receivables. So in this case, if you expect like 1 million euro to receive in like 3 months, so you expect 1 million euro in 3 months. Again, you have no idea what's going to happen to euro between now and 3 months. Then what you do is you selling futures contract, so that then you lock in the price at which you can sell the euro in 3 months. All right. So here here when you expect the 1 million euro in 3 months, you purchase because of the uncertainty and the exchange rate risk. You sell futures contract so that you can sell this currency, the 1 million euro, in 3 months at the for sure amount, for sure price, right? So locked in price. So that is the another the reason you sell, like you short futures contract to hedge receivables, so that you can sell that 1 million euro in 3 months without any uncertainty. Okay, that's the one. Closing out a futures position. Usually, futures position closing is you take the opposite position. So seller of currency futures, that's a short position, right? Short position can close out their position by long position, by buying identical futures contract prior to settlement. So the short position will be canceled out or closed out by long position, and long position will be canceled out by short position. That's mostly it is done that way. It is done that way. But small number, small percentage, it's actual percentage are settled in actual delivery, right? But here, let me show you one example, right? So here, the first one, January 10, you long futures contract. You buy futures contract is it include the contract to buy 100,000 Australian dollar at the 53 cents per Australian dollar. That's the futures contract. So you bought this one. You long buy this position on January 10th. So you are in long position, right? You're in long position. So the total, if you look at this one, is like 53 cents, 100,000. That will create $53,000, payable. So you have to pay because you are in a futures contract, right? So 53,000 payable. But here, in the settlement date is like March 19th, You see that? Settlement date. Where is it? Settlement date, third Wednesday of March, or June, September, and December. So in this case, you purchased January, about 3 months, like in a futures contract, right? So you bought this one, you're in a long position. Now, settlement date is March 19th. So you take care of this one. You take care of this one, close out this position, long position. You take on short position. So meaning you buy in you contract to sell. Is that you short means you sell futures contract. Now this time is sell it at the 50 cents per Australian dollar. The 100,000 Australian dollar is standardized. Here, look at this one. Standardized size, the contract size. So that will, if you have this short position, that will create a $50,000. This one is receivable, right, at the settlement. This one I told you said the payable, right? Payable. This one is receivable. So that is you take on this like short position on February 15 is before settlement date. Now, since you are in a long position, short position, this one will be canceled out. And then on settlement date, the only thing that remains is on settlement date. Now, this one was payable, this one was receivable, and just match these two and finalize this one will result on like $3,000 loss. Okay, loss. So that happens on settlement dates, and your position the canceled out before that. But your settlement happened on settlement date, March 19th. Okay, I'll show you more details on this example. Okay, I made the story, the long story about what's happening about this one. Okay. Now, that was one example about the closing out futures contract. Speculating with futures, currency futures. This one is short position. You use, in this case, used your short position. So speculators, investors, they got into short position here. So it's like, what is that? It's peso, right? Peso, 9 cents per peso. The one is okay. It's not shown here, but the peso, the contract unit is the 500,000 peso. Okay. So it's the all right. Is your short position. That means you will be like you're expected to you're supposed to sell this like 500 peso at 9 cents on settlement date, right? Okay. Now, this like speculation, like said, the short position that happens when short position that happens when traders sell futures contract to profit from a drop in the currency value. So if a currency, I mean the investor, the speculators believe that, or like expect like peso will go down in the future, then they take this one short position on the futures contract. Now, then between like this between this the April 4th and June 17th, you actually buy peso on the spot. So like 500,000 peso, you buy that at the 8 cents per peso. So it happened. I mean, the speculators, they projected the peso value will go down, and it happened, right? It happened. So what the speculators does before settlement date is to buy on spot here, right? So and everything, the finalization settlement will happen on the settlement date. The next settlement date is June 17th, the third, like Wednesday of June. Okay, get this one here. Because of because of this the short position contract to sell, this one it is receivable, right? Expect this, the person will receive $45,000 in at settlement. Now, this speculator also bought this peso, half million, 500,000 peso at 8 cents per share per peso. So already paid $40,000. So at settlement date, this guy, I mean, this speculator will receive $45,000, and then sell these pesos that he already purchased, and that one cost was $40,000. So 40,000, this speculator's profit will be $5,000. Okay. Do you understand how that happens? Okay, that was short example about futures contract, trading futures contract, long position and a short position there, and long position and the spot transactions. All right. I mean, this first example, I mean, similar examples there. Yeah, that's the same example here. Suppose daily settlement of long position in the Australian dollar futures contract. I told you, I mean, when we look at this one here, it says, first, can easily offset the obligation mostly, and very few by actual delivery. So we could see that from this example, right? And then another one is like it has some requirement there. One is we have to carry initial margin requirement about 3 to 6% of the value of the contract, and the maintenance margin requirement. So this is a requirement that we have to carry. And then daily settlement. See, it is like a daily settlement, marking to market. It's like a series of daily forward contract. This one means your investors or your the margin account should be settled every day. That will make this the trading this transactions much safer, right? So meaning I told you liquidity risk, default risk, credit risk, this one, the overall risk is lower. That comes from, mostly comes from this daily settlement. We have no idea what that means, right? So let me explain that in this story, okay? Daily settlement of the long position in Australian dollar futures contract there. So I use this idea, right? This idea on here. So let me use that here. So it says contract size is 100,000 Australian dollar, as you see there, right? Initial margin, the current initial margin, it is not on here, it is not on our textbook, but when I check the exchange market is like $2,420 for Australian dollar. And maintenance margin is $2,020. Okay? The currently. And settlement date is March 19th. March 19th there. Settlement date, March 19th. All right. So this person got into long position contract to buy at the 53 cents per Australian dollar, as you see there, 53 cents per Australian dollar. And then on the way in between, they got into short position to offset this position, got into short position at the 50 cents per Australian dollar, right? So, yeah, let me this one. So January 6th, I changed January 10 to January 6th because it is consistent. I mean, January 6th is Monday, Tuesday, Wednesday, Thursday. So to make, more consistent, more realistic, I changed the date. So January 6th, you got into long position. So you purchased contract to buy. And that decision is based on you expect this Australian dollar will depreciate, will appreciate in the future. That's what your expectation. So you purchased futures contract in Australian dollar at 53. Great. So let's do this. Okay. Now the first day you got this one at the 53 cents, but on that day the closing rate is 54 cents, right? 54 cents. So Tuesday close exchange rate, close rate is 0.5250 and so on and so forth. On Friday, 0.55, 55 cents. So given all this information, I told you the contract size is $100,000, right? So this exchange rate times contract size will be your contract value. So $100,000, $100,000 times your exchange rate there. And then the same thing for everything, right? So it changes here. The contract value increased, decreased, increased, decreased there, right? So we calculated contract value here. Okay, now gain or loss, like Monday night, your gain or loss, if you look at this one here, so you are in a long position. The value increase is your gain, right? Value increase is your gain. So to calculate value gain or loss, gain, the ending value minus beginning value, that is your gain. So $1,000, there was $1,000 gain, right? So the Tuesday it decreased. So the same way, just copy and paste here. All right. So I suggest you do the same thing on your Excel, all right? Excel sheet. Download the Excel sheet and follow the step. That would be the best way of learning. So if you calculate this, this is easy. I mean, the easy, straightforward process there. So you can pay attention to that. So you will calculate value change, and the value change increase increase, that is our gain, daily gain, right? So Monday we have the $1,000 gain, and Tuesday, $1,500 loss, $2,000 gain, 1,000, 500, gain and loss, 1,000. So we successfully calculated this daily gain, right? Gain. Oops, no. Oops, no. What is this? Yeah, that's right. That's what I mean. So let's calculate this one. Your margin account. You have to have your account for this transaction, right? It's called margin account. Margin account you have to carry. It says initial margin is $2,420. That means your beginning balance of your margin account should be $2,420. That's your initial margin, okay? Initial margin. The closing balance is your margin account balance, margin account balance. Your initial is $2,420. The closing balance, account balance will be your initial plus the gain for that for the day. So here's this one. $3,420. That is your closing balance, close balance, right? Ending balance. Now, the meaning of this maintenance margin is this. If your closing balance is lower than this one, lower than this amount, you will get a call from your broker, and your broker will ask you to add more money, and you see that the following day. Okay, so here the the Monday closing date is way over this your maintenance margin, so you have no problem. So that closing balance will be your, beginning balance on Tuesday. You start with the 3,420. That's your beginning balance. Now, during the day, you lost $1,500. So your closing balance, ending balance on Tuesday will be this one, plus this loss, the $1,920. That is your ending balance. So look at this one. I told you maintenance margin there, it is lower than maintenance margin, right? So it's a red flag. So you will get a call from your broker. Your broker will ask you to put more money to make at least $2,200. So you are required to add 2,200 minus this amount. So $280 to make your balance to like maintenance margin minimum. Okay. So if you add, you get a broker's call, you get a margin call from your broker, and you add $280, and that will make $2,200 on Wednesday. So you're okay. All right. All right. During the day, you got $2,000 gain. So your closing balance, ending balance will be your beginning balance plus you gain this one there. $4,200 is way over maintenance margin. You don't have any problem. Okay. So this one will be your beginning balance on Thursday. So 4,000. Let me just do this way. Copy that. You started this one, and on Thursday you got another $1,500. So your ending balance will be this one plus this one. That's your ending balance, way over to the maintenance margin. So that will be your beginning balance on Friday. And on Friday you lost $1,000. So your ending balance will be $4,700. So you don't have any problem here. You don't have any problem. So this way, the reason I showed all this detail, I mean, this detail, you don't find it on our textbook, but this is the actual transaction, daily transactions, right? So the exchange market, I mean, the brokers, doing all this like daily transaction or daily settlement, this process is called marking to market. This one here, look at this one. This is marking to market, daily settlement. That is called this one. Why do they do that? By doing this, they lower this liquidity risk, default risk, credit risk, all this risk significantly, right? So that is this process. It is called marking to market or daily settlement. That is like significant feature of this futures contract transactions. Okay. Now, at maturity, I'm at settlement, like the March 19th at settlement. So everything should be finalized. So since you are in a long position at the 53 cents, your receivable, I mean, you expected receipt will be this times 100,000, right? 100,000 times 0.53. I mean, let me 0.53 there. Okay, it's already there. So that's $53,000. That is the that is your payment, not the receipt. It's because you are in long position. Yeah, you expected to pay $53,000. $53,000. That is your expected payment. But on the way, you got into short position to get rid of this in a long position. So, but that was at 50 cents per 50 cents per like Australian dollar. So from this like short position, you are expected to get like $50,000. That's 100,000 times 0.50. So this one here, right? So your net gain at settlement is this one, the last value minus this one here. In this case, actually, you got the loss there, loss. In doing so, you got this loss. Okay. All right. Here. That is what happened here. $3,000 loss. $3,000 loss. Right? It happens. It happens. And suppose you have round trip commission. If you reflect commission here, your total loss, net loss, will be $3,027. Okay, $27. That is example of like the trading daily settlement of long position in the Australian dollar futures contract. I just used the same information here. Okay, I just used same information, and I should just show how this happened and what is the detailed procedure daily there. Daily settlement, right? You see that it's called marking to market, and this is the finalization of this transaction at settlement date, March 19th. So the net accumulate loss of $3,027. All right, okay, that was your long position. Let's talk about short position there. It is also in the same way. We can take care of this one here. So euros, daily settlement of short position in a euro futures contract. Let's talk about this one here. The euro, as I said, the 125 euro 125,000 euro. That's a contract size. Initial margin for euro is currently 3,250. Maintenance margin is 2,400. So settlement date December 14th. So October 3, that's the Monday. December 14th, that's the Wednesday. Okay, so let's do this one here. The story goes like this one here. Like October 3rd, the Monday, you get into short position. You sell futures contract at 1.22118 per euro. Now, in between, and between this like October 3rd and your settlement date, December 14th, you take like long position to offset this short position. And that way, at the settlement date, your position is cleared, right? Canceled out and closed out. So let's talk about this one here, the daily settlement on this short position and how it is finalized, okay? Monday, October 3rd, you are in short position. You sold futures contract at 1.2118. Why do you do this? Why do you do this one? Why do you get into short position? Is that the contract to sell your position? You get into short position. You get a short position when you expect this the euro value will depreciate in the future. If you expect that, if you project that the euro will depreciate in the future, then you get into short position, and this happened. So you have this one, you have this here, right? All right. You got into this here, and Monday, Tuesday, Wednesday, the same way, like the exchange rate the closing exchange rate will be like this. So contract value is again, 125,000 times this exchange rate there. So we have this, and then if you copy and paste, you get this here. Okay, you get this. So this is contract value. Now, the next one is you have to calculate gain or loss, right? Gain or loss. Now, you should be careful. This is tricky a little bit. Now, when you are in long position, you are long position, then value increase is your gain. Value increase is your gain, right? Increase is your gain. But when you are in short position, value, wait a second. Value increase is your gain. Value decrease is your gain here. So short position value gain is decrease there. So get this one. You have to calculate the opposite to long position. There, that's the one here. So on Monday, based on closing exchange rate, you got $125 gain. All right. So you do the same way. Go this way there. So what do you have here? We have loss here on Tuesday, gain on Wednesday, loss on Thursday, and gain on Friday. So it says initial margin is like 3,250. So here, 3,250. You start with that. And then closing is you start with this one plus your like $125. That is your ending balance. It is way over your like maintenance margin, so you have no problem. So put it there. Now, on Tuesday, you lost $1,050. So your ending balance is your beginning balance plus your loss. $2,325 happened to be lower than your maintenance margin, 2,400. So you get a call from your broker, and your broker will ask you to put like $75 to make this beginning balance on Wednesday plus this one maintenance margin. So 2,400. So maintenance margin. So you don't have any problem here. And there you gain $200. So this one plus $200 there. So you have $2,600 is over your maintenance margin, no problem. And then you have start with your $2,600, and that you lost again 287. So plus this one gives you $2,313 is again lower than your maintenance margin there, right? So you will be asked to add $83 to make your beginning balance on Friday $2,400. That is exactly maintenance margin, right? So you don't have any problem. Now here, this one plus you got $662.50, $3,662 there. Okay. So okay. So now you're your short position, you expected to receive short position. It is your right to contract to sell your currencies, right? So from that short position, you expected to get this amount, right? You expected to get this amount, and wait a second, okay. All right. So, and the buy long position, I think this one it is supposed to be why don't you change this one to 08? All right, 08. Why don't you change this one to 08? 08. 08. Okay. That is correct, I believe. So you change that. So this one, short position, your expected payoff should be 151,475. Your long position, your expected payable is supposed to be $151,350. So your overall gain will be this one minus this one here. So $125 gain, it is the gain, right? But you have to pay round trip commission. Suppose it is $25. Your net accumulated gain will be $100 from these transactions. Okay, for these transactions. All right, this is how to complete the daily transactions and then the final transactions and calculate net accumulated gain this way. So the net accumulated gain here is like $100. All right. All right. That was example of futures contract transactions. One long position, one short position there. So this process, daily transaction or daily settlement called marking to market, that makes this futures the contract whole transaction safer, right? Safer by eliminating this risk. We're eliminating this risk. Okay, this way. Now, that was about the currency futures contract. Now, let's talk about the currency options contract there. Right. Currency options, the first offered in 1983 by Amsterdam, Montreal, and Philadelphia Exchange. So, the both futures and options are relatively new product, right? New instrument. Call option is the right to buy a specified currency at the strike price, contract price, strike price in the future. Call option. Okay. So we'll talk about this one here. Is your right to buy currency in the future at the specified price called exercise price. Now, the one famous discussion about this option contract is the option premium. But this option premium is quite the advanced level, so it is not is above our class discussion. So I didn't include any details, any technical details, but just one thing, conceptual discussion is about this one here. Now, Destiny, what you did that? Eric?
Yeah.
Yeah. Can you go over this three?
Yep. So spot price relative to the strike price is the higher the spot rate relative to the strike price, the higher the option price will be. For length of time before expiration, the longer the time to expiration, the higher the option price will be. And then potential variability of currency. The greater the variability of the currency, the higher the probability that the spot rate is greater than the strike price.
Okay. Yeah. All right. Now we're talking about the option pricing, the factors affecting currency call option price, right? Call option price. As I said, all this technical details procedure is above our discussion, our class. So three factors is spot price, spot rate minus the strike price, right? That's the one. And the next one is length of time to expiration and potential variability of the currency. So look at this one here. The higher the spot rate relative to the stock price, the higher the option price. We'll talk about this one, option pricing there. Look at this one here. This is the call option, and it says, given the option premium is the option price. We're talking about this, okay? We're talking about this. This is the per Canadian dollar, means the total is $1,000. That is the option price. Okay, option price. We're talking about that. So that price was 2 cents per Canadian dollar. So that means here, look at this. The higher the spot minus strike, the higher the option price. So if it is higher, then this 2 cents option price should be 2.5 cents or 3 cents, something like that. And length to maturity, right? Time to maturity, that's also positive effect there. The longer the time to expiration, the higher the option price. The greater the variability of the currency, the variability is measured by standard deviation, right? The higher the probability that the spot rate is greater than that one. The probability that's so this 3 has positive influencing factor for option pricing. So positive, positive, positive. Okay. Now the next option contract is called put option. Put option is is different. The first one is the right to buy. This one is right to sell a specific currency at the strike price in the future. Okay, so that is a put option. So the factors in this case, the second, length to maturity, time to maturity, and potential variability stays the same, right? Stays the same. But this one, the first one, spot minus strike price, will be negative impact, because this one was to the right to buy. This one is right to sell. So it goes to the opposite direction, right? So negative, positive, positive. All right. Now, Ethan. Ethan.
Guys, yeah.
Yeah. Can you go over this one here?
All four of them.
No, just one. First one.
Hedging with currency options.
Mhm.
Call options to hedge payables, project biddings, possible acquisition bidding. Put options to hedge receivables. And then the second one?
Yeah, one more. Yeah, one more.
Gotcha.
Mm.
Speculating with currency options. Call options when a currency is expected to appreciate in the future. Put options when a currency is expected to depreciate in the
All
future.
right. Thank you. Now, currency options. Option contract, you can use for two purposes. One is risk hedging. The other one is speculating, in other words, it's like investing purpose, right? So you have no idea what that means, right? I'll show you what that means exactly later on. So let's start with the hedging with the currency values there. So call option to hedge payables, project biddings, and possible acquisition bidding. Now, if you have the payable obligation, in foreign currency in the future, or project bidding, you got this one also, you're payable, right? You have to pay. Possible acquisition is also payable. So when you have payable in foreign currency in the future, you use call option to eliminate the exchange rate risk. Right? So call option means, I told you, is the right to buy a foreign currency at a pre-specified exercise price in the future. So you already know your exercise price for your future payables, meaning your uncertainty disappears. Okay? You just simply simply got rid of the exchange rate risk. All right. Now put option. This one happens when you have receivable in foreign currencies in the future. So when you receive the foreign currency in the future, then you need to sell it. You need to sell it, right? But between now and future, there's a lot of uncertainty. You have no idea what's going to happen to that foreign currency value. So in that case, you get this put option. You buy this put option. Is the right to sell a specified currency at the predetermined exercise price in the future. That means in here, when you sell this future, the foreign currency receivables, when you sell this one, then there's no uncertainty because you got the put option. So that way you eliminate the exchange rate risk there. Okay, and exchange rate risk. So that is the first important reason for this currency options is hedging, risk hedging. Now another one is speculating or risky investment with currency options. Call options when a currency is expected to appreciate in the future, right? I'll show you that later. When let's think about it. When you expect a foreign currency is projected, will appreciate in the future this way, but you get call option, so that means you have the right to buy a currency at the fixed rate, at the predetermined rate. Then you can possibly get the profit from those two prices. Put option is the opposite. If you expect the currency will depreciate in the future, then you get the put option. That means the right to sell the currency at the specified exercise price. Okay, I'll show you what that means graphically later on. All right, Ethan Wager.
Yep.
Yeah, can you finish this too?
Speculating with combined put and call options. Long straddles, short straddles. European options and American options. European options exercised only at the expiration date. American options exercised at any time up to the expiration date.
All right, thank you. Now, first, European option is European option is exercised only at expiration date. So this one is you can exercise or finalize, settle your transactions only on the expiration date, right? American option is it can be exercised at any time before, up to the expiration date, right? So this is more flexible, but in analysis, the analysis purpose, European option is much more convenient and simple, but American option is more flexible. See? Now, speculating with the combined put and call option. Now, this one is quite a little bit advanced strategy. The put option and call option is like simple strategy, right? Simple strategy. What is it? Yeah. But this, if you combine put and call option, it will give you quite interesting, different shape of strategy. So there are two things: long strategy, short strategy. That means long means you buy, right? Buy put option, buy call option at the same time. That's called long straddle. But you sell it, sell put, sell call option at the same time is called short straddle, right? This short straddle, long straddle, we will talk about in the next page there, right? All right, that's quite interesting. I'll show you that. All right, let's look at this. Buying a Canadian dollar call option and buying a UK pound put option. Let's talk about these two different options, and then let's see what happens there. Now, Faith.
Yeah, do you want me to read the buying a Canadian
Yeah,
call?
this one.
U.S. importer agrees to pay 50,000 Canadian dollars to a Canadian exporter in 90 days. To reduce exchange rate risk, the firm purchases a European call option, a 70-cent Canadian dollar call option. The firm has the right to buy 50,000 Canadian dollars at the price of 70 cents per Canadian dollar in 90 days. Given the option premium of 0.2 cents per Canadian dollar, option price equals 50,000 times 0.02 equals $1,000.
Thank you. So this call option contract, Canadian dollar. First, Canadian dollar, the unit size is 10,000 Canadian dollars. So Canadian dollar. So this one is five contract, right? 5 units, maybe 5,000, 50,000. So U.S. importer agrees to pay $50,000 to Canadian dollar in 90 days. So meaning is in the future. So there's a lot of uncertainty between now and 90 days. So to remove exchange rate risk, our company purchased the European call option, the Canadian dollar call option at 70 cents per Canadian dollar, right? So that means the company has the right to buy $50,000 Canadian dollar at the price of 70 cents per Canadian dollar in 90 days. It makes sense, right? That way, all uncertainty or exchange rate risk is eliminated. But there's small price for that. It's called option premium. For this one, the two option, you pay 2 cents per Canadian dollar, or for the entire contract, 50,000 times 2 cents is $1,000. It's the price for risk management, price for risk management there, right? So contract size is 50,000, exercise price is 70 cents, and option price is 2 cents per Canadian dollar, or 1,000 per entire contract, 50,000. Expiration date is 90 days. All right. So the break-even price is the exercise price, right? It is you have the right to buy, right? Right to buy. So you actually will pay 70 cents, and also you have to include the option price that you pay. So you have to include both. It's a 72 cents. 72 cents. That is the break-even price. Break-even price. That means if the spot exchange rate in 90 days and at that expiration is greater than 0.72, if the spot rate, future spot rate, is greater than the break-even point, it is called you are in the money. You are in the money. Let me explain. If it is 0.75, if the future spot rate in 9 days is 75 cents, what does that mean? In the future, in 90 days, the future spot, the market price is 75 cents, but you have the contract price of 72 cents, including the option price. Do you have the right to buy this one at 72 cents, including the option price? So you are in the money. That's why it is called you are in the money. All right. Suppose if it is 0.70. If the future spot rate is 0.70, then the future spot rate is 70 cents, only 70 cents. But you have the buy price is 72 cents. It is called you are out of the money. In that case, and if you are in the money, you have to exercise the option and get the profit. Exercise option and get the profit. If you are out of the money, you don't do anything. Just leave the contract expired. Don't do anything because you are out of the money. Okay. All right. Now let me show this example, this story in the table and graphical way, right? To make it easier. Get this one here. If the spot price, if you possible spot price is this one. Let's include the whole thing, one thing. Okay. Then spot price, let me bring it over here. And strike price is 70 cents, 70 cents, 70 cents there. We'll go in 70, and then let me copy and paste there. The all cases is the strike price is the 70 cents. It's contractual price for your purchase, and you pay 2 cents as option price. All right, there. Look at this one. I told you If the future spot rate is greater than like 72 break-even point, you are in the money. You are in the money. That's it. Exercise the option and get to enjoy the profit. Okay. So let me show you here, break-even point. So you have the spot price there and then your exercise price. So the unit profit is calculated this way. Spot price minus exercise price and option price there. Look at this one, 0, 0. That is why it is called break-even point, right? And if the spot price is higher than that, let's calculate that one here. 74 cents minus 70 cents contractual price, and then option price 2 cents. You get 2 cents profit, 2 cents profit, right? Right, the same way, let's calculate, copy and paste. Copy and paste is 4 cents, right? If you calculate this one, I mean, I look at this here, is you are in the money, you get the profit. Now you are out of the money in this way. You are out of the money, less than 72 cents. You don't do anything, just leave it expired. The only thing is you pay this one here. You pay this. The only payment is 2 cents minus 0.02 there, minus 0.02, and also minus 0.02. That is your price, and that is your cost, minus 0.02, no, 0.02. That is your cost. I told you this cost, this cost is the cost of risk management, right? No matter what you have to pay. Now, this is unit profit. So let's change the whole thing to the entire. So 50,000 times unit price is this one there. And let's copy and paste there. See? So if you look at this way, when you are in the money, when you are in the money, you get the profit, right? In the money, you get the profit. When you are out of the money, you don't do anything. You just pay option price. Okay. So the profit schedule, net profit schedule, graphically, this is the one. I mean, I just show this one is minus 10, minus 1,000 there. And then this is 1,000, 1,000, and this is 2,000 there. That is a graphical illustration of net profit schedule, payoff. Okay. So you are out of the money, you just pay like $1,000 cost option price, but you are in the money there, you get the profit there. And if it is higher than that, oops. If it is higher than that, you know what? This one, let's put it this way. If it is higher than that, it will continue that way, all right? Continue that way. So the shape of profit schedule for like call option should look like this way, right? Remember this. So the beauty of this, call option here is this. If the price, future price, I mean, I told you, if the future price, you expect future price to appreciate, you take this, call option, long position in the option contract, right? Long position, you long call option. What happened? You get profit, right? If your expectation of the currency like appreciation that happens, then you get the price, you enjoy profit. But if the profit, I mean, the Canadian dollar, the exchange rate goes in the other direction, unfavorable direction, you are protected there. You're protected. You see that? It is supposed to continue to lose here. But since you got the option contract, you got the option contract, you are protected here. You're protected. You're protected from any further loss. So this is about like risk management protection. this is about your profit. So I think, okay, this one here. Hedging, risk protection against the exchange rate risk, that is, there's achieved in here. But speculating investment profit, it is achieved in here when the Canadian dollar moves the change to favorable direction or area. Favorable movement, you enjoy profit. Unfavorable movement, you are protected. That's the beauty of this, call options. Okay. All right. The next one is put option. Hannah?
Yep.
Yeah. Can you finish this one, please?
Buying a UK put option, right to
Oh.
sell at 30,000 pounds at $1.40 in 60 days. Contract size 30,000, exercise price $1.40, option price 2 cents or $600, expiration date 60 days.
All right, thank you. So this is the put option is, as I said, you get the right to sell British pound in the future, right? In the future. So again, is not obligation, it's the right to sell. So buying a UK pound put option is the to sell 30,000 British pound at $1.40 per British pound in 60 days. So I think British pound is the unit size is the 10,000. So this one is 3,000. 3 contract, right? So right to sell 3,000 at the $1.40 is the strike price, exercise price in 60 days. So contract size is like 30,000. Exercise price is $1.40, and option price is 2 cents, or 2,006, right? 30,000 times 2 cents. That's the $600, right? $600 per the entire contract. Expiration date is 60 days. So, okay, let's analyze this one here. Break-even price. Break-even price is the $1.40, right? $1.40. See that? Option price. Option price is the right to buy. You are long position, right? You buy. That's why you included option price. But in this case, you are in a short position. You right to sell. So option price is option price that is imposed not on you, but somebody else who will sell the British pound to you. I mean, buy. Somebody who will buy British pound from you, since you have the British pound $30,000, 30,000 pound. Okay, so it is the right to sell. Okay, so in this case, break-even price, the put option, break-even price, you have to subtract $1.40 minus, wait, just a moment, wait. Let's take it back. Since this one is you buy put option, you have to pay option price. You have to pay option price. But when you sell it, you get the $1.40, right? Sell it, you get $1.40. So is your sales revenue minus your cost. So you have to subtract. You have to subtract in this case. Okay, got it, right? I made you a little bit confused, but just take this way. You have the right to sell this one at $1.40, but you have to still you have to get you paid for a put option, so you have to pay $2 there. So your option price is like the break-even price is $1.40 minus 2 cents. So $1.38. That is your break-even price. So it's different, remember the difference between this call option and put option there. Now, so in this case, if the spot exchange rate in 60 days, the expression, if it is lower than this break-even point, then you are in the money, because you sell your British pound at the $1.40, and then net of like option price, you the $1.38. So if the future spot rate is lower than $1.35. If future spot rate is $1.35, then when the price, the market price is $1.35, but you have the right to sell at $1.38 net of the option price, then you are in the money. You understand that, right? But if the future spot rate is greater than $1.38, like $1.39, you are out of the money. You don't get anything, any profit, right? So keep that in mind. Now, if the future spot rate is this way, and strike price is your selling price, so you have to put it $1.20 and copy all of your selling price. Okay, and then you have to pay option price, spot price, to calculate net profit here. Yeah. Oh, there, yes. Spot price is this one. Spot price is this one. Let's match that in here. Okay, so this way, or is it this one here? Let's go this way. All right. And then option price you paid. Option price 0.02 there, 2 cents. Oh yeah. 0.02 cents or 2 cents, no matter what there. Okay, now, as I said, if the future spot rate is less than $1.38, you exercise put option and get the profit, enjoy the profit. So how do you do that? You sell it at $1.40, and spot price is this one when start price there. So your price, net profit is this one minus this one minus this one here. You get the 4 cents profit, right? 4 cents profit. And if you do the same thing for this one here, exercise. This is the case when you exercise your put option, right? So you get this profit. But when spot price is higher than your break-even price, you don't do anything. You don't do anything. Just pay this one. So, you don't do anything. Just leave the contract expired, right? So you pay 0.02 here minus 0.02. That's minus 0.02 and copy and paste there. See, there's the unit profit schedule. Okay, unit profit. Let's make it total profit schedule. So the total is 30,000 times this one there, and then let's copy and paste there. So this is your total, the profit schedule there. See that? Okay. So when you when the stock price, the future spot price is higher than your break-even price, then you leave the contract expired, don't do nothing, and you just only pay like this option contract. So $600, that is your like price, cost of risk management. And here, if the future spot price is lower than this break even, you start to enjoy your profit there. So that is your net profit schedule, total net profit schedule. If you show that one graphically, this will be your like schedule there. So this way, when the future spot rate is less than your break-even price, you start to enjoy this one. And if it is higher than that, then you are protected. Again, the beauty of this, put options contract in this case, it shows when the stock price, when the pound value goes favorable direction, you enjoy your profit. When it moves to the unfavorable direction, you are protected from further loss. All right, that's the beauty of this option contract. Okay. All right. We just talk about this to call option and put option. So call option and put option, we talk about this one here. Now, that is the case when you buy. When you buy this, the call option and put option. When you sell it, it's just mirror image. When you sell it, it's a mirror image. Okay? So we just we analyzed the first two cases. When you get a call option, when you buy call option, when you buy put option. When you sell it, is the opposite, mirror image there, mirror image this way. Okay. All right. That being said, the last discussion is this one here. Okay, I told you, right? There is here straddle means that happens when you buy put and when you buy call simultaneously. So you combine that one, that happens long straddle. When you sell put option, when you sell call option simultaneously, that's a short straddle. So let's talk about that. All right. Yeah. Okay. All right. I put all the answers for your convenience there, right? Convenient, right? It says, right. Howard or Brett?
Yep.
Yeah.
Okay.
You
Just
read
that section
one,
right there.
please?
Resca Inc. has constructed a long euro straddle call option on euros with an exercise price of $1.35 as a premium of 0.021 dollars per unit. A euro put option has a premium of $0.016 per unit. Some possible euro values at option expiration are shown in the table below.
All right. Thank you. So if you go back there, look at this. The call option, if you buy call option, your net profit, unit profit was spot minus strike price minus option price. Remember that? In this case, when you exercise that, spot minus strike minus option price. When you are out of the money, you just pay this way. Okay, you just pay that this way. All right. All right. Okay. So it says call option is, the exercise price is $1.35 and the option price is, 0.021. So 0.021, exercise price 0.021. Your break-even point is the sum of these two, right? You add those two. So 1.371 was break-even. That's a call option. So 1.371 is located in here, in between. So there's a break-even point there. Now, as I said, if you are in the money, your price is your, the call option, the profit is here. This spot price minus, oops, is it correct, right? Minus, actually, this sum of this one is break-even point. So 1.371. That is your net profit. This one also, the spot price minus exercise price minus option price. That means 1.371. That's your profit. That's your profit. It's a net profit. But if you are out of the money, you just pay your option price. You just pay option price there. Okay? So if you show this option, the call option payoff schedule, it should look this way. You see that? We did that, right? We did that. So 1.371, that is the break-even point. That is break-even point, zero profit. Okay, zero profit. So that happens this way. As you saw in here, option price, the call option, we saw exactly this way. Now, the put option, it says the put option premium is the 0.016 and exercise price is $1.55 or 35, same thing. So exercise price and option price, this one. So break-even point is this minus this. Remember that? We calculated break-even point here. The exercise price minus option price, that's the put option there. We got 1.334. So for along this future spot and a possible spot rate, 1.334 is located in between here. So 1.334. So again, if you are in the money, if you're out of the money, you just pay option price. That's the one. If you are in the money, this is what we did. If you're in the money, we said strike price minus spot minus option price. That was our unit profit there, right? So strike minus spot minus option price. So this one, spot minus strike price, where is that? Spot minus strike price is 1.3. Wait, it's just no. Oh, wait. Strike price, yeah, strike price. See, strike price minus spot minus option price. So this one here, this one, strike price is $1.35 minus spot price minus option price 0.016 there. That is our profit schedule. And this one is strike price $1.35. 35 cents. What's going on? $1.35 minus the spot price minus 0.016 there. And also this one, strike price 1.535 minus spot price minus 0.016 there. So look at this one here. This is our net profit schedule, not net profit schedule. So it is here when you are out of the money, you are protected there. You're protected. When you are in the money, you enjoy here now in this one. Okay. That's the break even. Break even. When you are out of the money, you just do anything, just leave the contract expired and you just pay the option price. And then you are in the money, you start to enjoy your profit there. So if you show this one, net profit schedule graphically, it shows this way, right? Exactly as we did here, okay? This shape around like break-even point. This one is break-even point 1.5371. So so net profit, if you sum them up, I mean this one comes from here. I mean nets. I mean, it's I told you computing the value of your euro call and put option combined. Call put option simultaneously. So to establish, to construct the long straddle, you buy call option and put option simultaneously. So let's put this together. So this one is this one, call option plus put option there. And the same way, copy and paste. That gives you your net profit of your long straddle, meaning the combination of call option and put option simultaneously, right? That is a net profit schedule for that, long call and put option simultaneously. So if you put this one on here, okay, this is summary of this calculation. So this is your net option put option there. What's going on there? So this is net schedule for a combined call put option there. And if you show this one graphically, what is that? What is it? You see this one, right? 413,263 and 0 and minus 0 and 113 there. What do you see there? You see straddle, right? Straddle. But this shape of straddle is called long straddle because it came from the combination of buying call option and put option. Yeah. All right. Now it says, we go back there. It says speculating is the with combined put and call option. One is long straddle. That means this is one strategy, trading strategy for these speculators, the investors, with by combining put and call option. That's the long straddle. We got this long straddle. So what's the meaning of this? Now, this strategy, long straddle strategy that happens should be long straddle. When investors, traders, when investors when investors' projection is like future pound, British pound option, the euro. If the future euro will be highly volatile, meaning highly volatile means if it is like far from this center, it should be this way or this way. If if your projection is like the highly volatile euro in the future, then this is your strategy. What that means is, no, if it is highly volatile, that means here, look at this. What do you see? You get the pretty significant profit there, right? And a little less volatile, you still have this the profit. But if you go this way, if you go this way, if you volatile this way, positive way, this way, then you still enjoy profit. If it's a little less volatile, you still enjoy the profit. But if euro value turns out to be very low volatile, that means it should be around here. If you go this way, it is not volatile. What do you see there? You get lost there. You get lost. And if you are around here, you get lost. So if your projection is like highly volatile euro around here or around here, then this strategy will give you pretty delicious profit. Okay? But if the outcome is it was not the contrary, if it was turned out to be not volatile, it is around here, concentrated around strike value, then you lose money there. You see that? So this is the best strategy when your projection is like highly volatile movement of euro, then this should be the strategy. Okay? I think one of the questions, one of the homework assignment or quiz homework assignment will be like this. Okay? Looks complicated. The question look complicated, but if I show you this way, I think exact same question there. So I put it in here to show its simplicity. It's not that difficult. Like if you follow the what we did here, it turns out to be quite straightforward. Okay. So you have to understand the process, and you have to understand what we did here to solve this question. I think is one of your homework assignment, right? Short straddle. Again, this one should be straddle. Short straddle is, look at this one, is the mirror image. This one is, when you buy long call option and put option simultaneously, this happens. When you sell it, I told you, when you sell it, it happens this way. When you sell it, it's the mirror image vertically, right? So mirror image vertically this way. Look at this way. That's a short straddle. Now, again, I think you understand now, right? If your projection is like very high volatility there, then this is not the one. This is not the right strategy. Highly volatile, this is not the strategy, because you are losing a lot of money here. But if your projection is like very stable, low volatility of euro in the future, then around this, concentrated in your strike price this way or this way, that is your strategy. So if your projection is low volatility, very low volatile movement of euro in the future, this is your strategy. If you do that, if you construct short straddle, what do you see? This one, around this one, if the euro turned out to be low volatility, less volatile, then you will enjoy the profit there. You see that? This profit. Okay? So that's the opposite, right? So if you expect low volatility in the European Euro movement in the future, then short straddle is your strategy. If your projection is like high volatility in European Euro action in the future, then long straddle is your trading strategy. Got it? All right. Let me stop the recording. How do I stop recording? Stop. Where is it? Not recording, yes.